Hello, everyone, and welcome into crushthestreet.com. I got a hard-hitting interview for everyone today. I got Jeffrey Neilson on the line with us, a returning guest, and someone who's brought a tremendous amount of knowledge and research and information to the table in times past. And today, we're going to be talking about the markets. Obviously, the markets are being spooked right now with coronavirus. Stocks are down big. Gold has been up pretty big. I mean, gold's up 6% since the beginning of the year. Stocks are down 6% since the beginning of the year. Maybe those numbers are slightly off at the moment, but it's this massive bubble that we've seen in the stock market. We're seeing now this coronavirus to a certain degree be the pin for that bubble. But that's not to say that we can't keep going higher from here, or this is it. We're in the middle of it, and let's try to make some sense of that with Jeffrey Neilson. He's with dynamicwealthresearch.com. Check out his work there. They have a tremendous amount of free content. And if you like what you hear today on this interview, definitely check Jeff's website out. Jeff, thanks for coming on Crush the Street with me today.
Always a pleasure, Kenneth.
Well, sir, I'd like to start off with what's going on with the coronavirus right now. As I said in the intro there, we're seeing stocks down, gold is up. There's a lot of doom and fear. You know, when we talk about endless money printing, tremendous amount of debt, all these things don't seem to spook the markets. The threat of World War III, right? You know, the bombs going off in Iran. Again, water off the back of the markets. But the coronavirus, something that's killing, a certain amount of people, spreading lots of conspiracy theories around this. People don't know what to think about it, and markets are hesitant, to say the least. What are your thoughts on this?
Well, you summed up the situation, pretty accurately in terms of the parameters. So, not much to add to that. And of course, definitely, we're seeing this pandemic fear translate into the broader markets. And so you referenced the other scares that didn't really seem to be able to derail the rising markets, especially rising U.S. markets. And of course, the reason this is different is, there's no way at all at this point that, analysts and traders can shrug this off. When the coronavirus first emerged, I was a bit of a skeptic, of course, because we had SARS and the massive but short-lived fright around that. And so of course, in the early days, nobody knew if this was actually going to really get some legs or whether it was going to get stamped out quickly. But it's reached a stage now, of course, where it's impacting the global economy directly. We're seeing international travel slow. We're seeing at this point, isolated sectors that have already acknowledged they're being directly economically impacted by this. So, of course, as you mentioned, with markets at extremely elevated levels, this is the sort of news that cannot be shrugged off because it's going to definitely have an impact. It's going to have an impact in the relatively near term, and it could easily get worse, even much worse, before it gets better. So, for all those reasons, no surprise at all to see the markets finally take this seriously.
So how serious do you expect the market to take it to that degree? Is this a reset moment? I mean, is this a chain reaction? Because there's one thing when there's a correction, markets go down 1,000 points, and then the bull market just continues to go on, right? But if we really come to a grinding halt here, there's enough of a slowdown in the economy, then there's that reversal of the trend. The recession has to cycle through. Bankruptcies and defaults and so many things need to go through for us to capitulate and to get to that bottom, as opposed to just a quick correction and business as usual.
And of course, part of the issue here is that it's not just equity bubbles that we're looking at, equity market bubbles. Of course, look at urban real estate markets. Insane price levels in most of the major urban markets across the Western world, fueled by the bubble interest rates. How do you create a real estate bubble? Take interest rates low. How do you create a massive real estate bubble, take interest rates to the lowest rate in history and leave them there. So we've got ridiculously inflated real estate bubbles. We've got major stock bubbles in U.S. equity markets. And then, of course, there's bond markets. So we've just talked about how the coronavirus is going to directly impact the U.S. economy, which is already the world's largest debtor and is drowning in debt. And yet, we see this fear pushing up the price of these bubble bonds. So you got the world's largest debtor who's already clearly insolvent. So the U.S. should be paying the highest interest rates on its debt in history. That's what the market says. All this nonsense about U.S. bonds as a so-called safe haven, it doesn't wash. It hasn't washed for a decade. This is just nonsense. And of course, what's propping up these bond markets is this ridiculous sovereign Ponzi scheme. So, of course, you're not allowed to buy up your own bonds officially in the open market. That's monetizing debt, and that's what bankrupt governments do. So what you have all of these Ponzi scheme governments doing in the West, and of course, Japan's in this ring around as well, is they buy each other's bonds. So you'll have the US buying Japan's bonds, and Japan buying the UK's bonds, and the UK buying the US's bonds. And of course, they puff up their chests and say, oh yeah, we've got demand for our bonds. That's why the prices are so high. Well, yeah, sure, you pump enough money into anything and you can take prices to anywhere you want, and it's called a Ponzi scheme. And this is what we have in sovereign bond markets. Ever-increasing quantities, ever-increasing supply of this debt at these ridiculously all-time bubble prices as these insolvent economies get more and more obviously bankrupt. It's absolute market fraud.
Jeff, let's talk about gold in this environment. Obviously, it's been pretty exciting the last year. Obviously, in hindsight, we've been in a pretty strong bull market since the end of 2015, right? But it's been hard to acknowledge that or know that in the middle of 2016, while we saw a quick little bounce up, but then things kind of trudged along in 2017, 2018, and it wasn't really until 2019, once again, when things started to tick higher, and then we broke through 1,500, 1,400, 1,500, 1,600. We're really starting to see momentum, build momentum here, and especially with the fear that's out there, it really is starting to feel like the potential is there for a rip-roaring bull market.
So I'm going to differ from you a little bit here in terms of timing. So you referenced, the rise of gold prices dating back to 2015. At the beginning of 2016, I was very outspoken in referring to this as a fake rally. And for me, the big clue that this was not a real rally was the day I saw an article come out from JP Morgan predicting a new long bull market for gold. And for your viewers that don't understand the significance of this, JP Morgan is by far the biggest silver short in the world. It has this massive, permanently large short position in the silver market that's out of all proportion to market fundamentals. And of course, in any sustained bull market for gold, silver always outperforms. Not sometimes, not maybe, always. So here we have the world's largest silver short supposedly predicting a new long bull market for gold, which could theoretically bankrupt JP Morgan if that translated into rise in silver prices. So JP Morgan had this fundamental internal interest in not promoting any sort of bull market in gold or silver if there was a real bull market. So when I saw this massive silver short predicting a long bull market, it's like, okay, well, this is nonsense. This is just a charade. And so I called where the prices could go in 2016. How high silver could go, how high gold could go before they were capped, and of course the prices did turn down before they hit those levels. But so for me, the price action that's interesting started in August 2018. Gold dipped below 1,200 for the last time. And so since August 2018, we've seen the price of gold up roughly 40%. So, that's a shorter time frame, and this is the For me, this is the rise in the price of the gold that has some legs, both because of the circumstances we have, in macroeconomic terms, the coronavirus, and just because of the magnitude of the rise. Of course, 7-year high for the price of gold. It's no longer at a point where you can dismiss this as a fake rally or just some short-term move. But of course, we also need to talk about what's really driving these higher gold prices.
Yeah, and I'm curious what your thoughts are with silver. Silver isn't necessarily outperforming gold at the moment. There's I don't know, dead weight. There's short pressure. I mean, what's going on with silver, and why aren't we seeing it keep pace with Big Brother here?
So, of course, that's a very good question, and it's a good question for a lot of reasons. To start with, there's the long-term historical gold-silver price ratio, which for thousands of years hovered around 15 to 1. This reflects the natural supply ratio of the two metals in the Earth's crust. But then, of course, over the last century, we've seen this immutable price ratio be wildly distorted. At times, it's stretched even more than 100 to 1. And currently today, it's approaching 90 to 1. And in fact, with prices today, it might even have just broken 90 to 1. So this is insane for several reasons. First of all, what you hear every day from the mainstream media is that silver is now, quote unquote, an industrial metal. And of course, this is at best a half truth because silver still has massive monetary demand, and you need to look no farther than India for that. India treats silver as money. And in 2018, India alone scooped up 1/3 of the global silver supply as money. Western mints still mint silver coins, legal tender silver coins as money. So silver has never stopped being a monetary metal. It's never stopped being a precious metal, but it has this massive industrial demand for two reasons. First of all, silver is the most versatile metal out of all the metals on the planet. It has an incredible number of very potent chemical, metallurgical, and molecular properties that give it this versatility. And then the other thing, of course, is that it's been so dramatically underpriced that industry has been encouraged to not only use silver, but to overuse silver. And then the most important factor is because silver has been so grossly underpriced, it was priced too low to economically recycle the silver that has been used industrially. So for decades after decades after decades, all of this industrial silver has been getting used up and thrown away, used up and thrown away. So the global stockpiles of silver have literally been consumed. And the world's leading authority here is Ted Butler. He's on the record for a long time as saying that 90% of the world's silver is gone. So let's look at the price ratio again. We don't have 15 times as much silver as gold today on the planet. That implies a 15 to 1 ratio. We don't have 10 times as much silver. We don't have 5 times as much silver. Where people who study these markets closely are now saying it's very possible we have more gold above ground on the planet today than silver. And yet the price ratio is 90 to 1. And of course, when we note that the price ratio for gold and silver has mirrored the supply ratio for thousands of years, this indicates an equal preference for the two metals relative to supply. Silver was 15 times as plentiful. It had 1/15 the price. But now there may be more gold on the planet today, so why isn't silver at $1,500 an ounce?
Well, Jeff, that's an interesting question, and something that I've been starting to ask people now is it fair to start questioning silver's role in society? And does it still have the same properties of sound money, wealth, storage as it did 50 years ago, 100 years ago, and all throughout history today? That's my question.
So there's a few ways to answer that. Of course, I already mentioned India and the fact that and India, of course, the Indian population are the world's most savvy precious metals consumers. People know of their massive attachment to gold, but these are extremely shrewd precious metals buyers. So, of course, the reason that India soaked up 1/3 of the world's silver supply by itself in 2018, and of course India doesn't have many industrial applications for silver. That was all money. Um, the reason it soaked up so much silver in India, and the reason that silver buying in India can radically spike, in certain years, is because when they see the price ratio stretch, it's like, okay, silver is an incredible buy. They pile into silver. So, for your viewers, questioning silver, I would say, look to the world's most sophisticated precious metals consumers, see what they do, and maybe think about learning from them. And of course, the other way to answer that is simply look back home. So, as I mentioned, we still have Western mints coining legal tender silver money, and these mints continually struggle to keep up with sales. So that's even in the West, where silver has been badmouthed for 100 years as merely an industrial metal. So despite all of that anti-silver nonsense, we still have some very robust demand for silver amongst a small kernel of sophisticated precious metals investors. And so those are pretty powerful arguments there. The one other more historical point I would make is that out of all the Western populations, only one really has any cultural attachment to silver, and that's the German people. So why do Germans still highly regard silver as a safe haven? Well, because Germany, the few German centenarians that are around today are the last people in the Western world that have a personal living memory of a hyperinflation. And in the Weimar Germany's hyperinflation, people who had silver survived. So, as economic conditions have worsened and become more and more questionable, as our fiat paper currencies have been debauched to ridiculous levels, as our economies become more and more insolvent, Germans have been stocking up on silver. So again, this is something that your audience may want to think about. The only people with a cultural memory of these sorts of economic conditions are still heavily into silver.
Jeff, does the Fed come into this situation where we have stock market volatility, gold prices rising? I know they're not necessarily watching the gold price, but maybe they are actually as a competitor to the US dollar. But do they just come in with record stimulus? And does that help what's going on with just massive drop-offs that's happening in the overall stock market and bond yields and just everything that we're seeing right now during this crisis mode?
So one chart that every person who follows markets needs to look at is the US chart for velocity of money. Velocity of money, it's a fairly simple statistic. It's how often every dollar that's in circulation gets spent. And so higher velocity of money implies economic health. A dollar is getting spent over and over again. That's encouraging. Of course, velocity of money can go too high. Economies can overheat. But generally, what you're looking for is a robust level of velocity of money as an indication of economic health. So if you look at the U.S. velocity of money based on the M2 supply, what you see is this upward curve right up to basically the dot-com bubble, where velocity of money hit all-time record highs, and it was obviously way too high. The U.S. economy was way too overheated at that point. Since then, since before the year 2000, the U.S. velocity of money has been in this sickening downward descent. And since the start of the so-called U.S. recovery, the velocity of money for the U.S. economy has not merely plunged down to all-time lows, but it's plunged below all-time lows and just kept going lower and lower and lower. So think of the velocity of money as the heartbeat of an economy. And so what we've seen with all of this incredible monetary stimulus, insane interest rates, and it's just this money pump from the Federal Reserve is no response at all. They're injecting more and more liquidity in these markets, and the dollars are getting spent less and less often. In economic terms, this is called pushing on a string. So what happens when you push on a string? Nothing. So what happens if, when the Fed has gotten no return at all for all of the liquidity it's been pumping into markets since 2009, what happens if it ramps up this money printing even further, well, the velocity of money just goes into a steeper downward slope. Nothing happens. Pushing on a string harder doesn't generate any greater movement, because of course you can't push on a string.
So, Jeff, let's talk a little bit about your website and what are you recommending to people, or just writing? I know you're not making recommendations and things like that, but what is your overall sentiment for how to protect yourself in this environment? Dynamicwealthresearch.com. What are you guys talking about in terms of wealth preservation?
Yeah, well, just to clarify a little, so Dynamic Wealth Research is an affiliate site and a general market site, and of course I will be publishing content there. But what I really want to do myself and my partners is to launch a newsletter site, a paid site, and so that's going to be my principal focus going forward. We're actually expecting that to happen in the next few weeks, and then what that's going to be all about, of course, is a precious metals theme, of course. And as you know, going back several years, I've always been a strong advocate of precious metals, even when price action wasn't favorable, simply for its wealth preservation properties. And so, we're going to be reminding people that in a time of record uncertainty, having these metals with thousands of years of a track record as safe havens for wealth, that's a very important selling point. But of course, we're now talking about these rising markets. We're talking about gold at a 7-year high after roughly an 8-year bear market. But so something else that's really interesting to investors. So as we talked about, gold is up 40% since August 2018. But if you look at a long-term chart of the GDXJ, which is the most commonly cited index of mid-tier and junior gold mining companies, it's flat. It has not budged on this 40% run for the price of gold. So this is a massive disconnect, given that certainly in any bull market conditions, mining stocks are always expected to leverage increases in the price of gold. So not only have these stocks not leveraged this 40% move, they literally have not budged. There's been a few market darlings that have had some nice runs as gold has gone higher. But of course, you look at the index as a whole, flat. And of course, flat going back to 2012 roughly. So for technical investors, I mean, this isn't just building a base. I mean, this is like building the ultimate base of all time. And now we've got all of this untapped potential in gold stocks. So we're going to be talking about gold stocks as well, and of course silver stocks, because if in any sustained bull market, silver will have its run. It can't be stopped. But then, outside of that, because nobody wants to be 100% gold and silver, we see opportunities to diversify where there's solid value. So, from something conservative like, water ETFs, which just basically tick steadily higher year after year. Some of the other emerging opportunities in new technology, metals for new technology, so-called battery metals. I don't see broad moves for these particular battery metals simply because of the general depression in commodities markets, but I think there's going to be some strong individual opportunities in some of these resource companies. And then, of course, something else I've been doing in the last few years outside of precious metals is getting involved with cannabis. And so, here we have this emerging market that's been artificially shut off from commerce for 100 years. And now we're finding out that, this is a substance that has a remarkable number of medicinal applications. It's a benign alternative to alcohol and tobacco as a recreational drug, and it's putting out growth numbers that pretty much dwarf any other sector in the economy. But yet, cannabis stocks are currently extremely depressed. So there are some value opportunities right now, even in these uncertain conditions. So nobody can guarantee that in a panic that something that's cheap today won't get cheaper. But what can be said is if you get into things that are objectively cheap today, even if they get pushed down in some broader panic and get even cheaper, those are going to be the stocks that lead out of the crisis. And you need to look no further back than 2008. So all through that crash of 2008, gold and silver stocks got pummeled. And they were already cheap going into that crisis. Coming out of that, from the beginning of 2009 through 2011, gold and silver junior mining stocks were basically a 10-bagger. I mean, they left every other sector woefully in their dust. And so we have a setup now where these stocks are even cheaper already, and then we're seeing them going down right now. And so, if people are looking for an opportunity, not necessarily for a fast buck, but if they're looking for the next best opportunity once the panic clears away, you can't do better than gold and silver mining stocks. But you have to be careful and choose companies that are going to make it through any sort of period of uncertainty and emerge out the other side.
Well, I'm not going to lie. I wish I had a position in some rhodium stocks. Who really saw that one coming at a left field here? I mean, I'm looking at the chart back in December of 2015. Rhodium was in the $600 range. I mean, 20x higher here in 2020. And I just to piggyback off of that, closing thoughts. I mean, could we see some sort of rhodium type spike in precious metals? I mean, it's just so hard to think that could be possible based on the way we've been conditioned to see gold and silver trade. I mean, silver goes over $18, and here we are once again under 18. I mean, it doesn't seem to move a lot or enough to get excited about. And after it does have a big move with crazy news, it just gravity takes control of it. So what are your thoughts on this?
Well, by coincidence, I was just listening to an interview with Frank Holmes of US Global Investors, and the title of that interview is, why not 10,000 for gold? And of course, Frank immediately pointed to rhodium. He also pointed to palladium and the massive spike in the palladium market. And it's really funny because, of course, I saw the Frank Holmes interview at Kitco. And so you go to Kitco and, back to back, you have these two titles. Why not 10,000 for gold? Right above that, you have Goldman Sachs. Gold might hit $1,800 an ounce. Well, of course,
how exciting.
Yeah, so any precious metal bull, the first thing you need to do is tune out anything that comes from a big bank on gold. I mean, these are the ultimate gold haters. So, and of course, they come out with this and they call it a bullish projection. Wow, gold might rise another 20%. Wow. And then of course, compare that to palladium, compare that to rhodium. I mean, they're talking about trivia, and they're psychologically capping the gold market in people's minds to get them out of the thoughts of why not gold as the next rhodium or at least the next palladium. And of course, we haven't really had time to get into all of the actual fundamentals that are driving the gold market. So central bank gold buying, has been on this 10-year binge. It's at a 50-year high. So this is the real driver of the gold market because it eats up massive quantities of physical metal in a market with limited supply. So if you want to listen to any real gold bulls, they're going to have price targets for gold in the multiple thousands. If you see, any fluff talking about gold 1700, gold 1800, gold 2000 even, this is nothing. Gold should have gone to at least $4,000 after the crash of 08, just based on the massive expansion of the U.S. money supply. But it got capped well below 2,000. So there's still all this untapped capacity in the price of gold today. So yes, gold should be many multiples of its current price based on current fundamentals. And I agree with Frank Holmes. Why not 10,000 for gold? Why not 15,000 for gold? And of course, silver outperforms. So if we talk about gold going to this level, think what silver is going to be doing from 17 something today. So this is what serious investors should be looking at. Is the real fundamentals in these markets and the real price potential for these eternal safe havens.
Good way to end there. Why not $15,000 gold? Everyone, this is Jeffrey Neilson of dynamicwealthresearch.com. Check out his work and stay up to date with what he's doing. He's got a lot of exciting things coming down the pipe, and definitely a wealth of knowledge, to say the least. Jeffrey, thanks for coming on Crush the Street with me today.
Thanks for having me, Kenneth.